Hi everybody, it's Dave. I just want to go ahead and welcome you to our Value Charts webinar series for tonight. I'd like to go ahead and get started. I gave a couple of extra minutes here to anybody that may be showing up a little late. So if someone could type a yes in the chat box, just so I know that everybody can hear me. Excellent. Thank you, Ron. Okay, everybody. Well, first of all, good evening. I want to go ahead and welcome you to our Tuesday night webinar series. Again, my name is Dave Aquino, and I am the Options Live Trading Room Specialist here at Microquant. And we'll go ahead and let me get my pen here. Usually I have this started. Okay. Sorry about that, because I'll need that a little bit later. Again, tonight's webinar is focused on trading intraday divergences in Apple with options. I use Apple as the primarily trading stock for tonight's webinar, but this can be applied to several other really good trading stocks that we follow in the Options Live Trading Room. So again, tonight what I'm going to do is touch on and review some fundamental value charts and MQ momentum indicators and how they work. Then I'll go into a brief primer on options and how we use them to trade Apple intraday. Then I'll go ahead and show you the divergence trade that we usually use in the Options Live Trading Room. Show you how we apply them to Apple options, and then show you examples of the trade. And then I'll switch over to TradeStation, show you some live examples of the past couple of days in Apple. Okay? If you have any questions at all during my presentation, go ahead and submit them via the GoToWebinar side menu. I'll try to answer them as I go if they're pertinent to what I'm talking about at that moment for clarifications. If not, I'll go ahead and try to answer them all, the submitted questions, in the question and answer segment at the end of the presentation. And before we leave for tonight, I'll make sure that all questions will be addressed. Okay, here's the risk disclaimer. We at Microquant want you to know that trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, Value Charts does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content. Sorry. Hold on one second here. I just noticed that there we go, the risk disclaimer. Indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection herewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. CFTC Rule 4.41. This is a government-required disclaimer. The CFTC wants you to know that futures and options trading not only has large potential rewards, but also carries large potential risks. You must be aware of the risks and be willing to accept them in order to invest in the futures and options market. Do not trade with any money that you cannot afford to lose. This is neither a solicitation nor an offer to buy, sell securities, stocks, or options on the same. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. The past performance of any trading system or methodology is not necessarily indicative of future results. If you have any questions at all on either of these two disclaimers, feel free to go ahead and contact us at Microquant. Okay, now moving on to the topic of tonight's webinar, trading intraday divergences in Apple with options. Okay. Tonight, again, I'm going to first be talking about the indicators used in trading, value charts, and by extension value bars, and also the MQ momentum indicator. Secondly, I'll introduce you to some basics on stock options and discuss how to use them in your trading. And then thirdly, I'll be discussing the price momentum divergence setup and show you how to find them on stock charts and then how to trade them with options. Before starting talking about indicators and setup, I'd like to go ahead and touch on what we believe are the three most important components of technical analysis. The first one is price, second is value, and third is momentum. By combining all three components together, we believe it provides the most complete view of the current makeup of any market. The tools we're going to use to gauge these three components will be, for price, we're going to use the traditional price charts, the open, high, low, close bar charts. For value, we're going to use our proprietary value charts and value bars indicators. And for momentum, we're going to use the MQ momentum indicator. The settings of these indicators for value charts and value bars, we'll use a 5-bar analysis period. For MQ momentum, we're going to use the standard default settings of 3255. And also later in the example charts, we'll have two trend following MQ indicators, MQ regression and MQ trend. MQ regression will have a 100-bar analysis period, and MQ trend will have a 21-21-4 setting. Okay, just want to first mention the nature of value charts. And value charts are designed to provide an objective evaluation for the current price based on real past prices within a specific analysis period. Oops, I'm sorry. Okay, as you can see, through value charts, prices are placed within 5 primary valuation zones. The first zone is here, the green fair value zone. The next two zones are the yellow zones above and below the green zone. This is the moderately overvalued level, and this is the moderately undervalued level. And above and below those two zones are the red zones, the extreme valuation zones. This is significantly overvalued, and down below, significantly undervalued levels. Now, historically, prices are within the green fair value zone roughly 66% of the time. And in the yellow, moderately overvalued and moderately undervalued levels, prices are in those zones roughly 16% of the time. Now in the extreme value zones, prices are in those areas roughly 1 to 2.5% of the time combined. As you can see, prices tend to stay within fair value and just periodically enter the moderately and significantly over and undervalued levels. Now switching back to price, we see these are the traditional open, high, low, close bar charts. You can see right here from this bar, it's comprised of this left horizontal line, that is the open price. Then you have this big long bar that's comprised at the top of the high price of the bar and the low price of the bar and all the prices in between. And then we have this horizontal bar to the right, that is the closing price. Now these charts have been used for well over 100 years and are a good example of price over time. Now each bar represents price movement within a specific time period, if let's say these are 5-minute bars, or within a specific number of transactions, like if this is a 150 tick chart bar. Now on this next slide we see the again traditional open, high, low, close bar charts combined with our value charts level. Now the open, high, low, close bar charts again show both current and historical prices. Now if we add the value charts level, what we see is the price chart where prices are evaluated within the 5 primary valuation zones. Here you can see where prices hit significantly overvalued. Prices below that are here in the moderately overvalued level. Prices in this area here are in the green fair value zone. Prices here are corresponding to the moderately undervalued level, and as prices move further down, here we have significantly undervalued levels. Now, one thing to note, it is very difficult to see price and value at the same time on two different charts, especially in fast-moving markets. So that's why we developed value bars. Again, looking at the bar itself, you can see there is still the open price, the closed price, and the body of the bar. But what we also have is, in this case, we have both price and value. You can see the top part of the bar is in fair value, the middle part of the bar is in the moderately undervalued level, and here we have the significantly undervalued level, all within the same bar. This greatly aids you in identifying both price and value very quickly, and as you'll see, speed is important when we're trading intraday divergences. The third component of technical analysis is momentum. Again, here we have our value bars chart, and then we have our MQ momentum indicator. Now, what MQ momentum does, it seeks to gauge the momentum of a market, which is basically which is the strength of a market as it's moving down and up. Okay, this is very similar to a moving average convergence divergence indicator. You guys might know it as a MACD indicator or MACD to some, but MQ momentum is actually a proprietary indicator designed by Mark Helwig. Now, Mark took components of his favorite momentum indicators and basically created a hybrid that kept most of the most important momentum factors together. Now, looking at the indicator specifically, we see that it's comprised of this solid blue line. This is the indicator line. And then we also have a slow line or a trailing line, this dotted line. And then we have this histogram. Now, the histogram basically shows you the spread between the two indicator lines. In general, when price action is bullish, like in this case here, you can see that the indicator line is moving up and that the histogram is green and positive. When price action is moving down, we see the indicator line is moving down and the histogram is both red and negative. This way, you can see MQ momentum provides a clear real-time view of both direction and strength of price movement within a market. Okay, so we've gone over our indicators. The next thing we want to talk briefly about is a brief introduction to options. What are options? Basically, they can be thought of as the trading vehicles that derive their value from characteristics of an underlying stock. These characteristics are price, implied volatility, and the time until expiration of the option itself. Now, options also have aspects that are desired by options investors, specifically leverage and defined risk. These characteristics and aspects of trading options are another layer of complexity that we talk about in our options live trading room. But for the purpose of this webinar, we want to go ahead and discuss how we trade options. Options in general provide us a lot of trading tools that we can utilize in a large number of option strategies. But for tonight's webinar, we want to keep things basic. We're going to be discussing calls and puts as directional trades. So basically, when we believe that the stock price is going up, we go ahead and buy or go long call options. When we believe that the stock price is going down, we go ahead and buy and go long put options. Now, basically what we're doing is using options as a leverage substitute for owning stock. Now, then, once we decide to trade options, which one do we trade? If you've ever given any thought to trading options, you've probably pulled up one of these. This is the options chain of a stock, and we can see that there's a large number of options that are available to trade. For each group of options that share a specific expiration date, we can see that there are any number of calls and puts options that are available at all these different strike prices. Okay, now here you can see a option chain for Apple. Here's a stock right here. Okay, now which option do we trade? Now for the purposes of buying and selling calls and puts, we're actually going to be utilizing what we call Delta 70 in the money calls and puts. As for the specific expiration date, Apple has a weekly option, and usually there are anywhere from 2 to 8 days until expiration. And usually these weekly options are on higher volume stocks, and we do utilize a number of them in the options live trading room. So let's flip back to the options chain and take a look at it. Specifically, we look here, tells us the number of dates. This is on Thinkorswim. This is the option, the underlying stock, the number of days to expiration. The column that we want to look at for calls, here's the delta here, and delta here for puts. If we're going to go ahead and utilize a Delta 70 call, we'll look at for the Delta 70 or the 0.70 or a number that's closest to it. Here we have 0.77. And you can see those options are currently trading for $13.23 a contract. If we're going to go ahead and take a short position or buy puts, we're going to use it here minus 0.74. And those options are currently trading for about $11.15. Okay, that is how we find which options to trade. Okay, so the important aspect of trading options that you need to know is the fact that all trading setup signals are based on the price chart of the underlying stock. So it's the underlying stock, which is Apple. That's where we decide the buy point, the stop loss, and then where we define the exit or profit targets, etc. Now, once we make a trading decision, like yes, we are going to go ahead and enter the trade, then we actually enter all buy and sell orders on the actual Delta 70 options price. Again, this is specifically on this price here for calls, $13.23, and for puts, $11.15. Okay, just keep that in mind. Now, the best way to show you how this works is to walk you through an actual example. Okay, let's just say tomorrow morning we're bullish on Apple. Now, Apple is currently trading at $430 a share for this example, and based on the setup, we believe that Apple can go to $440 a share, maybe in the next couple of days. So what we'll go ahead and do is buy a Delta 70 call option because we believe the price is going to go up, and that currently is priced at $10 a contract. Let's just say by middle of the afternoon, Apple does very well. It goes ahead and shoots up $10. It goes to $440. Again, the price of Apple increases by $10. Now the value of the call that you purchased in the morning increases by $10 times the delta, or 0.70, which 10 times 0.70 is $7. So now, when Apple hits the targets you were looking for, the Delta 70 call option is now worth $17. It goes from $10 to $17 over the time span of one day. That's a 70% return. That's not unheard of, especially the way Apple moves, but it's a very good example of the leverage used with options. Okay, so the next thing I'd like to talk about is the price momentum divergence setup and how to trade it on Apple charts. And then what I'd like to do is go ahead and show you the nature of the divergence trade. Now, the best way to do this is to visualize what a divergence actually looks like and show you an example on a chart. Okay? This is the Apple daily chart. Now, again, we're trading intraday, but it's easier to show you on a daily chart because the price action is still the same. So price action on this particular chart, prices are moving up. You can see Apple comes up, makes this high right here, and then prices pull back, and then they make this next high here. Okay, prices are going from one high to a second higher high. If we look at the corresponding indicator, MQ momentum, we see that the histogram makes this height on the histogram, and this corresponds to the first set of highs. And here on the second set of highs, we see the histogram only making this level of high here. Okay, compare that to the first level of the histogram here. Now what you see is prices moving up here and the indicator not nearly making as a corresponding high. So that specifically is the divergence. So the trade actually is, once you see the divergence, we look for the first high, prices pull back. We look for the second equal to or higher high, and then we check the corresponding histogram. If the histogram diverges in nature, then we'll go ahead and look at an entry point. Now specifically, what we do on the second high is we look for a moderately or significantly overvalued level. Okay, prices are coming up, and then we would get in at this high here or this high here. It just depends on how you're reading the chart. What we do in the options live trading room is when we see the divergence, we actually watch the indicator line for it to go from a positive slope to a zero slope or a horizontal line to the point where it starts to turn negative, which is right about here. And that corresponds to this bar here. Okay? And at that point, we'll go ahead and go short Apple, or in this case, we will purchase a Delta 70 put. And then you'll see the indicator line roll over and prices likewise fall from there. Okay? So now we are short Apple at this point right here, and what we will do, we have several options as the trade develops. We can go ahead and sell. If we got in at moderately overvalued levels, the yellow upper bar segment, we can go ahead and start selling at the moderately undervalued segment right here. Or what we do in the options live trading room, we go ahead and follow the slope of the indicator line. As long as it's negative, as long as it's pointing down, we'll stay in the trade. And where we will look to get out is when the slope of the indicator line starts to flatline, like in here, whereas it continues down to here, or actually turn up at this point right here. Now, the technical way we manage this trade is actually we sell. If we go in with 5 contracts here, we'll sell a little bit, especially when we hit significantly undervalued levels here. So we'll continue and sell positions, and then we'll finally get out in a position like here. Again, this is on daily chart, so it is a little choppy as an example. But the most important aspect to remember is the fact that this is a divergence. High here, higher high here. Indicator, the histogram is high here. The histogram in the second high is lower than the first high, whereas prices are moving up. So this diverges. We go ahead and get short here on this bar and follow it down. Okay, does anybody have any questions on this divergence? And this is known as a bearish divergence because we are looking for prices to fall. Okay, seems like it's pretty clear to everybody. The next daily chart is the opposite example. This is where we have prices making new lows right here. This is the corresponding negative histogram. And prices come back up, and then they come back down. They make new lows here. And you see the histogram only reaches this low level here. So what we do, this is a bullish divergence. At this divergence, we'll look for prices to go ahead and move up. This location right here, either the significantly undervalued level or the moderately undervalued level here, are 2 good locations to get long, or in this case, to purchase a Delta 70 call. You can see the indicator lines coming down, and then it starts to turn up right at this level here. And this is a good place to get long. And we follow it on up as we hit. The first chance that we get to go ahead and take some profits is here at the moderately overvalued level. the opposite value level from where we got in. And then we continue, follow up the indicator line until this point right here, where it goes from positive to negative. So it corresponds to this location right here. So as prices are moving up, usually what we do is we sell at strategic locations, take a little bit of profit. We go in with 5 contracts. We can sell one here, sell one here, sell one here, sell one here, and then sell the last remaining position here. Okay, that way we're locking in profits as we go, taking some profits in case this rolls back down against us. But again, hopefully it's a little clear. You see the divergence, you get into the trade here, and then we start taking profits here on the opposite value levels, significantly overvalued levels, or when the indicator line actually, the slope actually turns down. Okay. Hi James, the examples here that I'm using are actually daily charts, but I wanted to show some clear examples of a bearish divergence on this chart here, and then bullish divergence here. Okay, bullish because we're looking for prices to move up. When I go into the next section, I'll be using live examples. I'm actually going to switch over to our trade station charts that I can show you on an intraday basis. Does anybody have any specific questions on the actual divergence trade itself? Because here on this particular screen I can draw, on the other screens I can't. Okay. Alright, seems like everybody seems to have a good understanding of them. Let's go ahead and switch over to our live examples. Okay. Let's see if I can, I'll go ahead and discard this. Alright, so now we've switched over to the trade station. You can see here in the upper left hand corner, these are Apple 250 tick bar charts. You can see that over here. Now this is the chart pattern for today. Okay, 6/11. You can see right down here. Okay. I'll go through this. Now, they're not as pretty as the example charts that I showed you initially, but it still does work in real life, and you'll see it. So today, Apple actually gapped down at the open, made this new level of lows right here. See the histogram? Prices came up, and then they rolled back down. Now, you can see prices here are made equally low, and they continued lower to this level here around 433.5. And you can check the indicator and you can see that the histogram was much shallower than they were here at the open. So this is a good setup for a bullish divergence, and a good location to get in. You see here moderately undervalued all the way down to this point right about here, that the indicator line turned up. Now, someone had asked specifically, what does the 250 tick bar chart, how does that correspond to time? Well, in fast moving markets, these bars will be formed faster than in slow moving markets. So specifically when we get in here, this is at 9:37 in the morning. And I'll show you after we do the trade how long it lasts. So this is from here to here is about 7 minutes. So again, we can get long here or here, either of these two bars. They provide good, but most likely it's the second bar here when the indicator line turns up. Okay, so we're long. We purchased some call, excuse me, some Apple call options. And as we move quickly, we hit moderately overvalued levels. Now, you can go ahead and start selling here because it's the opposite value level. But what we do in our trading room, we watch the slope of the indicator line. Okay, it's positive. It's positive here. It flatlines a little bit. You could sell one contract here. It's still positive. It continues up till right about here. Excuse me, when it starts to turn down. So from getting long here on this bar at 9:37, and getting out at this bar here at 9:49. That is about a 12-minute long trade, and prices move from here approximately 433.5 up to here, which is 437. Let's just say it's 437 even, because it could be anywhere along this bar. 433.5 to 437 is a $3.50 move in Apple. Now $3.50 times the delta 70, it's approximately $2.50 change in the value of the option. Now Apple options that are delta 70 at this level are usually anywhere from $10 to $12. So $2.50 on roughly, say, an average of $11 option. That's a really nice return of about 15% in about 12 minutes. Okay, so that is a good example of a bullish divergence. Now, as you can see, prices did continue to move up. We can continue to watch Apple here, and we come up to this trend line here at 442.06. Now this is a good example. We'll see prices make this high here. They pull back and they make an equally high high. Now we check the indicator. The indicator line is a good example. See the height of the indicator line here. And as prices pull back and make this new high, the indicator line is definitely lower than this line here. Same thing with the histogram. The histogram's this high in this area here. The indicator line, the histogram on the second high is nearly non-existent. Okay, it's barely into the green area. So a good location to get short in this particular case, because it's a bearish divergence, is this bar here, right when the indicator line is about to turn negative. So we go ahead and follow the trade down. Indicator line says negative. At this point here, you can go ahead and start taking some profits because the indicator line is sloping, is flat. You could also take some profits here and here on these two bars because we got significantly undervalued levels here. Now I'm going to zoom in a little bit. It might be a little hard for you all to see. So this point here and this point here are two good areas to get out, and then finally get out on this bar. Okay, so that small trade there went from about 442 down to about 439 and 439.5. So let's just say roughly, if you didn't get the exact top or the exact bottom, this went from this is about a $2 swing, and on a delta 70, that's roughly about $1.50, $1.40. Again, on a $10 to $11 option, that's a good 10% roughly. Okay, so that's a very nice example of a bearish divergence. But we go ahead and continue watching Apple's behavior. Now prices come up, reach that same 442 level. You can see the indicator line is in a way it's diverging again. See the height on this first high when it touches the line here. Then down here, the indicator line's only this high. And then the third time when it goes up, the indicator line is even lower. Now the histogram is definitely higher, so you want to be careful if you're going to try to trade this as a divergence. But if you do go short here because it's significantly overvalued, or even on this bar here, when the indicator line starts to slope down, you can follow it down and maybe take profits here or here. It's a much shorter trade, but if you were able to sell at moderately overvalued levels, sell opposite here, moderately undervalued levels, this is another approximately $1.50 move. So you can scalp trade that also. Okay, but as we continue to watch it, see we have highs here, and we have higher highs here. And look at the histogram. The histogram reaches this level here. The histogram level here only goes this high, about half the height. So again, we take this as a bearish divergence, sell here at moderately overvalued levels, and then sell here at moderately undervalued levels. Moderately overvalued to moderately undervalued. Right there, that's about another $1 to 75 cent move in Apple. Again, these are smaller scalp type trades. Here's another opportunity. Again, compare these highs here. The histogram reaches this level. Prices come back down and they move back up. Now, this is not a tradition. This is not an exact divergence, but it is possible to take it, play it as a divergence, because here we hit moderately overvalued levels. What you're always looking for is nearly equally high highs, and then we hit a value level, moderately overvalued, or in this case, or significantly overvalued. In this case, we get moderately overvalued, and prices move up. You can go short, and then by buying a Delta 70 put, and then prices move down. Now, if we went short here, see how the indicator line slope turns negative and continues down. You can sell it at this point here at significantly undervalued levels. So here, that's about a $2 move also, from high to low. Now, this usually happens quite quickly. So if you're able to get 60–70% of this move, it's a good trade. But really, this is a $2 move from 442 to 440. Okay, and then you can continue to follow Apple. Now, Apple, as it gets later in the day, it gets a little choppier. What you have here, you do have a bullish divergence. We have this set of lows here. Prices move up and they come down here. And now this is a connected divergence, so it's not as good as, say, something like this that's separated. But it is a divergence. You can go long here and then sell here or here. Prices move up. Let's see if there's any other really good example of divergences. Here, prices, this is all connected, but the high comes back up to here. It retests this 442 level. Again, support and resistance levels are very good locations to find divergences. Prices come up, they test this resistance level, indicator line, the histogram is this high. Prices come back down. They make another attempt to actually break through it here. See the height on the histogram bars here? They're much lower, so it's okay to go ahead and go short here. The indicator line turns over, goes negative. The slope of the indicator line goes negative, and you can follow it down till about here, whereas you can start selling your position. Again, it's okay to buy the put here, start selling here at the opposite value level. Here, this bar, and then this bar. And by that time, you're already out of most of your position when the indicator line starts to go flat. Okay, so that's another good divergence. And we can keep going. I don't see another divergence in this area. Okay, here's another example of a bullish divergence. See, we have this level of lows here. Here, prices are coming back down. They don't make an equally low low, but we do get into moderately undervalued levels. The histogram is definitely, look at the indicator line, it's definitely shallower. Here's the depth of this indicator line, and here on this moderately overvalued bar, moderately undervalued bar, it's only this low. So you could go long here with a Delta 70 call, and then buy the call on this moderately undervalued level and start selling on this bar and this bar here where we're moderately overvalued level. And then watch the indicator line. It starts to go sideways. You can, at this point, keep selling your position out until finally it goes against you back down here. Okay. You can also watch the MQ Momentum's histogram bars. When they start getting shorter like this, that's a signal that the upside move is losing strength. So it's okay to go ahead and start selling your positions there. Okay. And we just continue to watch it. Don't really get any good signals for the rest of the day. A lot of these divergences get really choppy at the end of the day, and that's what we have here. We just have it fall, so we really don't get any good divergence signals. Okay, Does anybody have any questions as to how we go ahead and process the trades throughout the day? Again, normally we just follow the trades. There are times where we let the trades develop, or at least within the first 5 to 10 minutes, and then we really start to look for some divergences. Here it just came early. But then most of the morning time provides good trading opportunities. We'd say anywhere from 9:40 all the way through about 10:15, 10:30. Divergence, looking for divergence is very good. Here's the first really good one. Here's the second one here. I would say all the way up to say about 11 o'clock. You can still find a lot of good divergences. And then in the afternoon, during the lunch period, kind of goes sideways. And then usually from 3 o'clock on, if there's going to be a divergence, usually it's something bigger. And the opportunities are also there. But going into the close, probably within the last 15-20 minutes, you usually don't get a tremendous amount of divergences. You'd want to only trade them if they're very clear. Okay. Let me double check the questions here. James, thank you. Do I always use the 250 tick chart? And do you take it if the regression line has not yet changed? Okay, good questions. We kind of, for intraday trading with Apple, as long as it has the quote normal amount of volume in it, we'll use the 250 tick chart. I've tried the 125 tick chart. It tends to move too fast. Let me show you what that looks like. Just as an example, look, see how kind of smooth this is. Okay, if we switch to 125, you'll see how it looks a little different. Okay, it's not, I wouldn't say it's better, but it gets a little bit more frazzled in some instances, like in here. You see how we're jumping up and down a lot. Here, you see all these sideways bars here. It's a little bit harder to trade. Here's that, let's see the opening move in Apple. And again, it's a lot of bars here, so I apologize for the fast forward nature. Here, it comes down, whereas before we had maybe just 1 or 2 bars. We had 2 bars down here at the bottom, now we have 3. It comes up, makes this here, let's look for that really good divergence up here. Here's the 2 divergence points. That doesn't look so bad. But usually in general, you see where this may be just 1 bar on a chart, now it's 2. So, and right in here, it gets really choppy. So it's just kind of the look and feel of it as it's developing. And, you know, it's just kind of a preference, what our eye has been kind of trained to. Now, the thing about also, if Apple's really moving fast, these bars form very quickly. And you see when we have the a move like this, see these red bars, this bar, this bar, this bar. This usually happens very quickly. So this would pop, 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 pop. And sometimes it's hard to catch that move. It's even harder. It's just as hard on a 250. But on 125, it could be much harder to visualize. See how it looks smoother now? Again, here's that same divergence from earlier. Okay. So that's why we use a 250 tick bar chart. Now, we do have other opening tick charts. Let me show you. That's Apple. Google, we use 125 tick. Amazon, we use a 125 tick, and then we've been starting in the past couple of weeks trading Tesla. We've been using 250 ticks. I kind of just played with those different levels and found that those work pretty well. Definitely for Apple, Google, and Amazon. Tesla, it's kind of in the works. It's been very busy the past couple of weeks, so it kind of works that way. Let's see here. Do you take it if the regression line has not yet changed? Yes, I do, and mainly because it's not a with trend trade. Usually it's the case that this is counter trend. Okay, see this right here? Low prices, lower prices, and what do? This is a bullish divergence. So it's counter to the trend. MQ trend and MQ regression are both red, but we're going long. Here, we're MQ, this divergence, this is a bearish divergence. We had equally high highs. We're looking for prices to go down, so we buy a put. Again, MQ regression and MQ trend are both green. Now there is one unique phenomenon. If you look here, see this divergence? We got one set of highs here. This second set of highs, it's not equally high highs, but it hits moderately overvalued level. You see how the indicator does not even reach green here? This is a good example of how usually before you have a change in trend, you'll usually have a divergence that kind of pulls prices back in the opposite direction. And in a way, if you catch this divergence, and we have in the options live trading room, it's kind of neat because it's like, okay, now we're short here, and then a couple of bars later the indicator line changes. We have to be careful if the indicator line is very, very steep, like this, very positive. But you look at the indicator line here, it's positive, positive, and then it starts to flatline. And then when it changes red, it changes direction. This is a negative slope. So sometimes we see that. But majority of the time when you're trading divergences, you have to be prepared to be counter trend. Because by nature, it's counter trend. We're making equally high or higher highs, and then we go short. Here, we're making equally low, or here equally low lows, but then we're going long. It's counter to what MQ regression is. Okay, so in essence, in a way, it is a counter trend type trade. Okay. What would cause me to hold this overnight? Usually it's the case, especially when I'm taking signals off a tick chart, I don't hold this overnight. And I usually don't make it a policy to convert a shorter term trade like this tick chart trade into something that I can hold much longer. Now, the only time I would do that is if I'm looking at here at a daily like a longer term trade, and I'm trying to get in, saying I see a reversal. What I will do, if I think Apple is going to fall before I enter a position, I'll look at a shorter term time frame like this 2-minute chart, or maybe a 5-minute chart, okay, and look for a bearish divergence. Okay, now you'll say, Dave, what's the difference? Well, the difference is I'm taking the bearish signal off of a daily. Like here, we're below this 438.06 level. Okay, I'm looking, if prices come up, they hit this resistance level and then they continue down. Well, I'm looking for confirmation of that here at 438.06, and then looking for a bearish divergence. Maybe prices are moving up and then they diverge and then they start moving down. That's when I will get in. Okay, that's how I utilize shorter term time frames and divergences, but the signal of the trade was on a daily. I hope that kind of makes sense. Ron, are you comparing me to Thomas? Thomas taught me. Thomas taught me a lot of this stuff, and I was in his options. I was in his futures trading room for a while before I became the options live trading room. And a lot of the ways, it's because of, I take it as a compliment, Ron. Ron compared me to Thomas. I take it as a compliment because Thomas is actually a very, very, very good trader. And one thing that I pick up from him and utilizing these value charts indicators is really how we can use divergences very well. Okay, and in reality, I don't know what you all traded before value charts, but I cannot trade without MQ momentum, because I see what prices are doing on a price chart, but I don't know what they mean unless I can see what the price momentum's telling me. I can see what prices are doing, but prices, if you see a divergence and you learn how to trade with divergences very well, you'll never look at a price chart alone, because you won't be able to tell, is this price coming back up here going to continue higher, or is it weaker actually and it's going to roll over? The momentum tells you what that does. It's almost like an x-ray as to what the intentions of this equally high or higher high means. Okay, so again, that's how what I look for on a longer term chart, as per your question. Your brain does not have the 125 tick speed. I understand that, James. It is faster, so you have to be careful. If you can't do it on a tick chart, then feel free to look for divergences on a 5-minute chart. They show up there too. That's a good time frame, or a 2 to 3 minute tick chart. I usually find in active markets, the Apple's 250 tick bar chart is probably the equivalent of a 2-minute chart. Therefore, okay, next question is, therefore in the afternoon we trade divergences from 3 to 4:30. Yeah, it's kind of a rule of thumb for me when I trade. A lot depends on the way the charts are looking. Do they tend to be choppy? You really don't want to be trading in the last excuse me, last couple of minutes, because everybody's have their market on close orders, and sometimes it does really crazy stuff in the last couple of minutes. You can see how we're trading like this, and nice and even, and all of a sudden we dropped off. I mean, this is the last 10 minutes here. Wait, no. I'm sorry. This is the last 15. This is the last 5. Do you guys see that? From here to here is 10 minutes, and then from here to here, the equivalent number of bars is the last 5. So the trades accelerate. But I don't know. Today was not the absolute best example for the last hour, because we really, if you zoom out, look at the price action in Apple. I'm trying to zoom out so I can show you guys the entire day. Okay, here. See, we had movement here, this nice movement here, pull back, and right about here at 10:15 we stopped this kind of action, this type of movement. And what did we do? We were in this channel the entire rest of the day. Okay, it was wide for a little bit. Okay, but here, starting at about 1:30, we hit this channel. We just bounced back and forth, and then at the end of the day we dropped off. So really, this is not the best example of the best trading environment, even for divergences. So you can look back. Let's see what the previous trading day. I don't even think this was the best day either. Yeah, Monday. Monday was a little messy also. Okay, it doesn't go all the way back, but this is that last half of the day. At least this seemed to be a little better, but not by much. Again, just wanted to show you those. Is it possible to use 233 and 512 ticks on TradeStation to correspond to toss? Yes, you can. You definitely can. I think you can just go back to here to format symbol and just change this to 233. I think you could do that. That's no problem. 512, that would be good too. What criteria do I use for a stock to be traded? It depends on what kind of trading you want to do, James. These 4 are what I refer to as our 4 trading stocks in the options live trading room. They meet certain criteria. They move in wide enough ranges we can trade them intraday. And secondly, and more as important, they have very liquid options because, you know, and the fact because they're very liquid, the spreads are kind of narrow. That means you don't have much slippage. Those are the three criteria. Amazon has been probably the, I wouldn't say worst, but of the four, this has tended to move the least in the past, say, couple of months, but recently it's just woken up. Google has come back off its really rocket trajectory and come back down to earth. Apple is probably the best moving one right now because it's, let me just show you, since it stopped doing, since it stopped its fall from here, it's been trading quite nicely. Google, this is what it looks like. It shot up and it's come back and it's moving up. So now it doesn't see this when it was moving up like this since middle of April into end of May. You couldn't trade this very well because it only knew one direction. It was up, then it came back down, then it moved back up. So that tends to be pretty good. Amazon, you see how it's been jumping around. These are daily charts, okay, and then it make this move up. So that's also the reason why I like to trade these. They respect support and resistance levels very well, but that's something for the options live trading room. I can show you that. Tesla is very similar to Google, but then it's come back down. Just as a little tip, see this? Head and shoulders pattern. Left shoulder, head, right shoulder. Hit this resistance level. It's fallen back. I'm waiting for it to break this neckline. It's kind of a crazy diagonal head and shoulders pattern, but I think if it breaks through here, it could run down a little bit. MQ momentum, see that? It's telling me what it's doing. You don't get this on a normal price chart. If you get anybody else, if you don't have MQ momentum or value bars, you don't see this. So anyway, price levels on the white lines, are they reset each day? All these little lines right here, well, a lot of the lines that I trade on these opening ticks, it depends on the nature of them. A lot of them are daily and weekly support levels, and then some of them like this, I put them throughout the day based on the low of the day, the high of the opening. When I see prices come up and they stop and then they test it again and then they come back down to here, I'll put these little levels on throughout the day. They're not specific for something on a daily or a weekly chart, but you can see how Apple actually respects them. Okay, see how many times it touches this line right here? 1, 2, 3, 4, 5, 6, and when it breaks through it finally, what does it do? It runs. Okay, this just comes from looking at Apple charts all the time, and you can easily do that when you get used to seeing tick charts and how they behave during the day. But yeah, in a way I reset them. I keep the main ones on there that correspond to these levels. Let me show you. See right here, descending trend line. Here's a level here, here's a level here, here's a level here. We go over those in the options live trading room all the time. Let me see if there's any other criteria. No, in reality it's liquidity, because we trade options, and if you don't have the liquidity and you have a lot of spreads, you can be right on a divergence trade if you're trading it intraday, but if the spread eats you up, you won't get much profit. Okay, does anybody have any more questions? I've held you here about an hour. So I'm sorry if it's a little too long. I'm just trying to make sure I answer everybody's questions. Let me try to get this back up here. Okay, now in light of all this, I would like to invite anybody. I don't have a formal open house right now, but anybody that managed to sit through this whole presentation and my examples, I think you'd get a lot out of visiting my options live trading room. I'd like for you to consider joining, but this is your opportunity to introduce you to my options live trading room. Again, this is where we focus specifically on trading options on stocks. The main ones you've seen: Apple, Google, Amazon. We also trade Goldman Sachs, MasterCard, LinkedIn, Netflix. Those are all good examples of stocks that we trade. Again, these stocks are actively traded, have weekly options, and they provide us good option liquidity and tight price spreads that allow us to trade intraday, and then also 1 to 3 day swing trading setups with ease. Normally, trying to get back. Normally we trade intraday and swing trades. We use directional puts and calls, and starting Wednesdays, Thursdays, and Fridays, usually we start to get into some credit spreads that focus selling credit spreads to take advantage of time decay on the weekly expiring options. I can go into some detail regarding that in the room. Now, our normal trading room hours are 9 a.m. to 1 a.m. Eastern Time. The normal price is $149 a month. I think that's a very good value because usually when I do some of the scalps in the room, easily we can do $200, $300 profit on a scalp trade like I've been showing you today. On the spreads last week, we pulled in, I think, $700-800 on the spreads that expired on Friday. So there's some really good opportunities. If the opportunities of trading stocks on options sound exciting and profitable to you, and you'd like to experience more, go ahead and send me an email at dave@microquant.com, and I can get you set up with a free pass for tomorrow for my options live trading room. You can also send an email to support@microquant.com, and Erin, she takes care of you there. She can also get you set up with a free pass. Feel free to join us tomorrow. We'll be talking about spreads. Thursday, you can join us if tomorrow's not convenient. Friday, we tend to be a little bit, depending on the nature of the market, tend to be a little quieter because we're just letting our spreads mature and managing them into expiration. So Wednesday, Thursday would be good opportunities to come see some of our trading. Again, I'd just like to go ahead and say thank you for spending time with us in this session, and I hope you found it informative and exciting. Any questions that you might have, you can send it to me at dave@microquant.com. Be happy to respond. Any general questions, you can send to support@microquant.com. Again, feel free to send me a request to join the options live trading room as a free pass for tomorrow. And again, let you know my name is Dave Aquino. Thank you again for joining me. Have a good rest of your evening.